Okay. Again, another good afternoon. I'm Ong Ai Boon, Director of the Association of Banks in Singapore. Welcome to today's briefing and thank you for your attendance, which today we have 1,000 registrants, full capacity from about 84 banks. So we're very glad to have you here with us. And today's briefing will focus mainly on the legacy transition issues and the implications for your corporate and non-bank FI customers. So we are pleased to have with us Bernard Wee, the AMD from MAS, and 5 chairs of the SC-STS work groups, 3 of whom will be the presenters and another 2 will be joining you on the panel to take your Q&A later on, and they will be introduced accordingly. So also please use your Pigeonhole portal to submit your questions throughout the presentations, and these questions will be addressed during the panel Q&A. And could you also help us to better organize these sessions if you could complete the feedback questionnaire on today's session, also provided in the Pigeonhole, and thank you for your cooperation. And now I want to just quickly wish you a fruitful, informative session this afternoon, and my pleasure to introduce Bernard Wee, Assistant Managing Director of the Markets and Investment from MAS. Over to you, Bernard.
Hey, thanks very much, Ai Boon. Good afternoon, everyone. Thanks for attending this afternoon's briefing session. I'm going to start with a brief recap of developments in the SORA space, but let me give you an overview of what you can expect this afternoon. So MAS has been supporting the Secretariat for the steering comms work. I will bring you up to speed on the SORA transition so far. Dan and Phil will take you through recommendations for derivatives and the corporate transition, respectively. Nicolette will cover customer engagement letter and public education campaign. We'll have that panel, as Ai Boon said, and then Ai Boon, I think, will wrap up for the afternoon. So for my segment, I'm going to cover 3 things and answer 3 top questions. First, timelines. So the key tenets of the dollar LIBOR will be discontinued immediately after mid-2023. So SOR, which relies on dollar LIBOR for its computation, will also have to be discontinued by mid-2023. We recognize this risk, so in 2019, ABS and SFEMC reviewed various options to replace SOR, consulted stakeholders, and identified SORA as the most robust and suitable alternative benchmark. And that's when they also formed the steering committee for SOR transition to SORA. LIBOR is also coming to an end, so we consulted stakeholders on what to do with SIBOR. Feedback supported a transition from SIBOR to SORA as well, and for SIBOR to be discontinued a year later by end 2024. So those are the timelines. Second, I want to touch on progress. Over the past 1.5 years, we've made good progress and are on track to meet the timelines that we set out. We established market conventions for the new SORA financial products, such as swaps, and we extended central clearing to 21 years. MAS has been facilitating SORA auctions to facilitate price discovery among banks. And we've also started issuing SORA floating rate notes to support the adoption of compounded in arrears methodology and to create flows for SORA derivatives. In the industry, SORA derivatives liquidity continues to rise. Today, it's about 8.5 billion of new originations. That was just in May. That's been a high, of course. And there has been growing adoption of SORA across a range of cash market products. So we expect this to accelerate in the coming months, with the industry ceasing to issue new SOR cash market products since April. The DSIPs have been ready to offer SORA-based products in quite a bit of scale since February this year, and other banks are expected to follow the DSIPs. So we have read a couple of weeks ago that DBS and Standard Chartered executed Singapore's first SORA interbank interest rate option on behalf of a global real estate group, and this represents a further maturing of the SORA derivatives market. The third, I just want to say that the gist of what I just described is that interbank activity is picking up. Third, want to touch on what's coming next. So the journey in the next has two big legs that we have to cross together. First, corporates, and then retail. Today, we're going to focus on corporates. In preparation for SOR to cease by mid-2023, we should stop entering into new SOR contracts and start winding down our books. For derivatives, to cease new SOR derivatives by end September 2021, and to wind down outstanding exposures over the course of the year. For cash products like loans, we should have ceased by end of April and transit SOR corporate loans exposures as soon as possible, no later than end of next year, 2022. The steering committee has also developed recommendations to guide the transition from SOR to SORA. These recommendations cover derivatives, bonds and perpetual securities, as well as corporate and retail loans. The recommendations we set out in a market guidance document to be published next month in July. We don't have a lot of time left until the end of 2021 and of course 2022. That's why we're bringing everyone here together and early so that you can prepare yourselves internally and begin to engage your customers once the guidance document is out next month. Just to remind everyone today that the focus of this afternoon session is on SOR, not SIBOR, because SIBOR is coming a year later. And we're going to focus on derivatives and corporate loans, not bonds or retail loans, because those are concentrated in just a targeted group of banks. And for those, we will reach out to those banks separately. Now, thanks very much for submitting your questions via Pigeonhole before today's session. We've identified and clustered, I think, 3 top questions that we thought we might as well address up front. The first question that we've heard is, why so urgent? Dollar LIBOR is only going away in June 2023, you know? Why do we have to take so much action now? Well, the answer to that is that market liquidity doesn't suddenly shift from SOR to SORA overnight. But the shift could also be quite discontinuous. Earlier, I talked about how we're building up SORA market liquidity, and that's going to grow. And if we're going to see SOR liquidity start to decline as well. At some point, when SORA grows past a certain size and SOR declines, I'm pointing my hands down the right direction. That shift could accelerate very quickly. So you really can't wait until 2023. The best period to transition out of your legacy book is most likely in the next 6 to 12 months from a market liquidity perspective. That's when SOR to SORA basis swap markets should continue to be conducive with tight bid-ask spreads, which would serve as a robust market-based price reference source to transition your SOR contracts to reference SORA. We can't be too certain about how long this window will last, but just don't wait too long. Otherwise, you just find it harder to hedge and pricing may widen or become more volatile as the pool of counterparties in the markets starts to dwindle. I think there are also 2 more things that we need for a successful transition. Number 1, don't add to the stock of SOR contracts that need to be transited. And that's why we recommended to cease the usage of SOR in new products. The second is you've got to compress and convert outstanding SOR exposures to SORA. But that was the first question. Second question, why can't we rely on the fallback rates for SOR to transition our legacy exposures? Now, let me be very clear about this. You should not. Now, unlike the other IBOR fallbacks, right, which shift contracts to referencing their respective risk-free rates, for example, SONIA and SOFR, fallback SOR does not shift your contract reference to SORA. Fallback SOR is intended to be a safety net to prevent disruption to SOR contracts, but was never designed as a tool to transition to SORA. Fallback SOR is also based on actual transactions in dollar sync swap and computed based on the fallback for dollar LIBOR, which is the fallback rate for SOFR in place of dollar LIBOR, right? So if you insist on using fallback SOR, you have to be aware it's not going to be constructed the same way as SOR. It's going to have basis risk from your regular SOR, and you can't get out of that risk because there's just no market for it. But even if you insist on using fallback SOR, that too is going to go away. That's going to go away in end 2024. So there is a final cutoff. And the final cutoff is necessary to prevent liquidity from being trapped in fallback SOR. Liquidity that could have otherwise been channeled into the SORA market. So for contracts that mature after this date, you really shouldn't rely on fallback SOR to avoid the need to have to go through a second transition. Third question that we spotted from the pigeonhole questions, is SIBOR a feasible alternative rate for us to shift to? No. SIBOR will also be phased out eventually. Like other IBORs, SIBOR is not sustainable given the structural decline in its underlying term interbank funding market, because banks' funding models have really evolved since the GFC. To set a reasonable time frame for the transition out of SIBOR, the steering committee recommended that we stop using SIBOR in new contracts by September this year. The less widely used 6-month SIBOR will be discontinued by March 2022, while the 1 and 3 month SIBOR will cease in end 2024. Transiting from SOR to SIBOR is really just delaying the inevitable. Lenders should avoid further building up the stock of legacy SIBOR contracts and transit directly from SOR to SORA this year. So I just want to sum up. I hope I addressed the top of the mind questions that you might have. And if you have further questions, I think we can take them after the panel. I should hand over to Dan next, right?
Thank you, Bernard. And that was very interesting. Just a point of note, I just realized that we're probably going downhill in terms of how people look. Don't worry, we'll hit a trough with Phil and then go back up again with Nicolette. So you have to bear with me for a while. Look, my name is Dan Koh. I am the Global Head of Treasury Markets at Standard Chartered Bank. Why am I here? I'm the chair of the subgroup 1, which is on derivatives. And hence that's what I'm going to be covering. I do intend to cover primarily 2 things, right? Firstly, some context on the market and the developments. And secondly, a kind of call to arms, call to action for you, the banks, to focus on the transition of your outstanding SOR derivatives. So can we go on to the next slide, please? Right. Now, just to give a little bit more context, right? We actually started work on this quite some time ago, right? From late 2018, with the knowledge that SOR derivatives would be severely impacted by LIBOR's demise. So as an industry collective, we got together to try to find a solution to this. Now, this led to the decision to recommend SORA as the way forward. And there was public consultation done on this. And it all led to the formation of the industry steering committee that Bernard talks about. So I'm here speaking to you as the chair of derivatives. And the subgroup's main aims are twofold, right? Firstly, it was to set up the infrastructure for a brand new market product, and then also facilitate the market development of it. And secondly, is to oversee the transition of legacy SOR contracts. Now, my subgroup is well represented by a wide array of banks, buy-side participants, and other industry stakeholders that you can see there. Now, all the members of the subgroup are committed to the development of the markets, and all the banks are actively trading in SORA derivatives now. Could we move to the next slide, please? Now, overall, some of the aspects that collectively as an industry we have been and continue to focus on, right? So on market guidance, for example, we have framed and uploaded the contract templates and put together the SORA market compendium last year. We also continue to focus on infrastructure readiness, right? So we aim to increase the transparency of SORA pricing availability and other such aspects, such as working with the clearing houses, as Bernard mentioned, to extend the clearing of our swaps out to 21 years. From a trading perspective, we started trading this in November 2019, right? And volumes continue to go up while bid-offer spreads continue to narrow. So that's all great. Finally, we are working with the broking community to switch to SORA as the primary reference rate, and this should help guide the community accordingly with our transition. Now, the next slide shows some very general and broad timelines that we're working towards. So the bottom half shows the wind down targets that all the banks are collectively trying to hit in terms of reducing our outstanding SOR derivatives. The upper half shows that we stopped using SOR for new cash products in April, and in September, as Bernard mentions, we will stop writing new SOR derivatives with some limited exceptions, which are primarily for risk mitigation and transition. So how have we been doing with these? The next 3 slides will show the industry view on how we've been progressing in terms of market trades. Firstly, this page shows some data on SOR, which is the legacy one which we're all trying to reduce, right? The left-hand side chart shows that we are steadily reducing our notionals of outstanding SOR trades. And the chart on the right shows the new SOR originations per month. Now, these are still high, but should continue to taper off, especially after Q3 when we all stop all new SOR transactions. And the majority of the new trades are short dated as banks look to actively reduce outstanding exposures. The next page shows the equivalent for SORA transactions. Here we can see the steady increase of the SORA notionals going up. And again, on the right-hand side, we can see the new SORA trades increasing per month. And in this case, it is more skewed towards the term over 1 year tenor, which is great. And then on the next page, some snapshots on the state of play for SORA derivatives. So on the left-hand side, we have the SORA OIS. Here you can see that the average bid-offer spreads have been getting narrower, and below that, the average number of banks actively quoting SORA OIS has been increasing. So that's all good. Similarly, for the SORA basis swaps on the right-hand side, it's a similar trend of narrowing spreads and increasing market participants, which is something that we are very proud of, right? So that's all well and good, right? But there's still loads to do. And this is where we hit the second part, which is our call to action. So if we can go on to the next slide, please. Now, we still have a fair load of outstanding SOR derivatives, both cleared and uncleared or by lag. So the left-hand side and the right-hand side, right? That's $1.6 trillion worth of cleared and about $700 billion worth of by lags. So we're going to be splitting this into 2. First, let's talk about the cleared. So the next page, please. So these are your bank's outstanding SOR derivatives that are cleared. So the $1.6 trillion problem that we have. Now, the good news is that we have already reduced this by 1.2 trillion this year by working collectively between the banks and external vendors such as TriOptima to compress or cancel a fair amount of our outstanding trades. So we have had dozens of banks participating in these cycles. Now, the success of this is dependent on the number of participants and also some other technical parameters that I will not get into here. But the point is, right, we have had many first-timers come in, and now we're looking to widen the net further and ask that your institution comes in if you're not already participating. Another initiative that we're looking at in the second half is in the second half of this slide, right? It's on conversion, which is as opposed to compression, right? So that is, we go through cycles where we aim to match banks and then convert the outstanding SOR trades to SORA, as opposed to compression where we look to compress and cancel, right? Now, this is a little bit more complicated than compression, so we're still working through some finer points. But alternatively, you can manage your risk by taking part in the SORA basis swap market to transition to SORA, as mentioned by Bernard. Ultimately, as you can see, there are upcoming cycles, and I would encourage you to contact these vendors to participate in them. The two ones being Trioptima and Quantal. Next page, please. So I just want to highlight two other aspects on cleared SOR derivatives, right? Firstly, on the PAI. Now, what is this, right? Now, clearing houses use a discount curve to calculate collateral requirements. Now, that discount curve is shifting from the current SOR to SORA in August. So, where applicable, if your institution is using SOR as your discount curve in your bilateral CSA with your clients, you might want to align this with the switch at the LCH so that you reduce your disparity. Secondly, and this is a pretty key point, right? Insofar as whatever we have left outstanding as SOR derivatives. So assuming you've gone through all these cycles on compression, or maybe you haven't participated at all, right? After you go through all this and you still have a stock of legacy SOR derivatives in the clearinghouse, what happens to these trades? Well, when the SOR market gets illiquid, the likelihood is that the LCH would force convert whatever is left. Now, no one knows yet what they will force convert these to, or how much they will charge, etc., right? But it will certainly be a headache. So absolutely, the no regrets move is to control your own destiny now and flatten your net SOR exposures as much as you can. If we could move to the next page, please. Finally, we go on to the part on uncleared or bilateral SOR exposures, right? Now here again, the message is pretty simple, right? You need to pursue active transition while the SORA basis pricing remains robust. Again, as mentioned by Bernard, right? So it's a case of striking while the iron is hot. So we've put a table there for you to see how we think it will progress, right? It's a limited window of opportunity that is open for you to capture this sweet spot. And we think it's likely to be within the next 6, maybe 12 months, right? Also, actively engage with your counterparties to agree on the points mentioned on this slide. Next page, please. So, right, where possible, right, if you have bilateral trades that can now be cleared, you should explore backloading these into the clearinghouse so that they can all go into the universe of trades that can be compressed that we talked about earlier. So it's moving the trades from the right-hand side, the 700 over billion, to the left-hand side, and then working to compress them, right? Our estimates are that almost all of the non-intra-group SOR IRS exposures that are bilateral can be backloaded. So I would encourage all of us to work on that. Finally, in summary, last page, please. This call to arms, right? Where you have cleared legacy SOR derivatives, please participate in these industry-wide cycles where we can all collectively look to reduce exposures. And do this while we still have control of our destiny. And secondly, for your bilateral uncleared legacy SOR trades, you have a sweet spot coming up to transition, right? Use that. And then look to see how much of this you can backload to the clearing house. Okay, that's it from me. As I said, we're going downhill in terms of look, so I'll hand over to Phil. Phil?
Thanks, Dan. Yeah, this is the trough of the discussion. It gets better after me, right? So my name's Phil Fernandez. I'm the corporate treasurer at DBS. So I sit somewhere between the markets business and the commercial bank. So I'll be walking through with you in the wearing the lead role on the SG3 subgroup, which looks after the corporate loans. So could we have the next slide, please? Yeah, so we'll just cover it in 3 big blocks. We've got 5 recommendations, but we've cut them up among the key messages, and we'll talk a little bit about hedge loans, which have some specific issues around them, and syndicated loans and SME loans, and we'll cover that as well. So let's move on to the key messages. Yep, next slide, please. Yeah, so I think as Bernard mentioned earlier on, I'm just summarizing here the key timelines that are relevant to the loan book. Dan's done the same for derivatives. So end April is what Bernard had mentioned. SOR usage was ceased for all banks. The BSIPs were a little bit earlier, and we're now past that point, so there should be no new SOR loans being written. So the focus of today's discussion is really around transitioning the legacy book. So we hope that by the end of this year, we would have transitioned most of it, and definitely by the end of 2022, that there should be hard stop over there. Don't forget that in the middle of 2023, SOR will cease altogether, and at the end of 2024, is what Bernard mentioned, fallback rate SOR will cease. So we are on, the train has left the station, and it's just important that we understand where the train is going to so that we can take the right actions. Okay, so we go on to the next slide, please. Yeah, so when looking at your legacy loan book, I think it's helpful to take it in 3 slices. And I saw a question in Pigeonhole just now. So the question was, for loans that are maturing before 30th of June 2023, do we need to do anything? The answer is it's not necessary. The easiest way is to allow the loan to mature, and the new loan will turn up and will have to be priced off SORA since there are no SOR loans at that point. So the focus of the rest of this discussion is around 2 slices of loans. Firstly, those that are maturing between 1st of July 23 and 31st December 2024. Our preference, our recommendation as an industry group is transition these from SOR to SORA. All right, and Bernard already explained why now is a particular sweet spot to do so, although optically you might think there's a lot of time left. Alternatively, if the customer really insists, then we would have to incorporate the contractual fallbacks by the end of 2022, and you will find those in some of the reference materials, which I will summarize at the end of this presentation. So there is something of an option for that intermediate set of maturities. And for loans that are maturing after 31st of December 2024, definitively transition from SOR to SORA. And try to avoid a 2-step transition to fallback rate SOR and then having to transition again. So in your communications with the corporate customers for this particular segment or this slice of the loan book, transitioning from SOR to SORA directly is the cleanest and is definitely the path that the committee is recommending to all of you. So that's first of all a maturity view on legacy loans. So new loans, everything's on SORA. There's no question about it. Legacy loans, 3 slices. And for the second and the third slice, definitely the preference is transition them from SOR to SORA. So in the rest of this discussion, I'll walk through how we're doing that and some of the recommendations to how to make that work more smoothly. So if we could have the next slide, please. Okay, so the first recommendation we have is that banks should use the SOR-SORA basis swap mid-rate to price the transitions. So basis swap, for those who might not be so familiar, allows us to exchange a stream of SOR payments for SORA plus a spread. And this spread is a fair market price when the market is liquid. So we've had discussions within the subgroup and with the steering committee, and MES has blessed this, that we would apply the simple average of the end of day mid rate over 5 business days going up to the transition date that has been agreed with customer to smooth the volatility, so that it's not dependent on a particular spike on a particular day, but you're picking up an average market level over a reasonable time frame. And the main focus at the moment is the outstanding bilateral and syndicated SOR corporate loans up to 5 years. So far, the basis swap market seems to be fairly liquid. I think Dan's shown you some of the data points there. We could expand this to loans with more than 5-year tenor as the liquidity improves for longer dated basis swaps. So as the basis swap market becomes more liquid, it may be possible to do this. We do want to caveat, and this goes back to Bernard's point, that the recommendation applies as far as the SORA basis swap market remains liquid, and therefore there's price discovery and it's a representative pricing reference. So there is a window of opportunity, and it's important that we get this message out from the banks to the customers without any further delay. Okay, let's move on to the second recommendation. So the key message here is that the markets are conducive to price your transitions now, but the liquidity may decline, as Bernard said, between 6 and 12 months from now, after end 2021. And Dan has also explained how the derivatives market is moving, and the fact that banks cannot enter new SOR swaps after end September 21, except to transition and to risk manage legacy SOR exposures. And there's a definite burn down of the outstanding pool of swaps. So the point we're making here is that as the banks stop trading the SOR swaps and liquidity shifts to SORA, the consensus in the industry group, when we discussed this at the steering committee with Sing Chong and the rest of the steering committee, was that we probably would see less trading in the SORA basis swaps. Now, no one's got a crystal ball, and we can't tell you how long this window would last. But definitely the message, as Bernard mentioned earlier, is take action sooner rather than later, so that at least as a reference point in the market, we've got a market-determined SORA basis swap pricing, and we can move on that. So that's the first really key message, and really hope that all the banks in this call have internalized that point. Okay, let's move on. So the second recommendation is to try and get it done by the end of this year. So again, aligned with this whole idea of the window of opportunity. So the first recommendation is around the pricing, and the second recommendation is around the timing, right? And we figure that this window is 6 to 12 months. And once you're past that, you'll find that, yes, you could still work out some kind of adjustment spread, but there'll be a lot more negotiation between the banks and the customers. There's less price discovery. And so the strong recommendation from the steering committee is to get the banks to engage corporate customers early to transition SOR loans to SORA in 2021. I'll talk a little bit later on some of the materials and the work that's been done to smooth that process. But we're really now at the stage where it's the last mile discussions between banks and individual corporates talking about individual loans. So it's really a bank talking to a corporate about a specific loan. So that's really where we're at right now. And that's why now we're having this forum to make sure as many of the banks as we can in Singapore on this page, even beyond the subgroup, which has about 14 banks and has a bulk of the exposure. Okay, let's step on. Okay, let's move on to hedge loans. And hedge loans start to introduce a level of complexity. And the recommendation that the steering committee has converged on is it would really make it a lot easier if we transition both the loan and the swap to the same interest rate index on the same date to maximize your hedge effectiveness. So there will be some discussion on hedge loan transition, but it will be more limited because there's a large number of possible permutations. Did you do a cash flow hedge? Did you do a fair value hedge? Did you do a many-to-one? Was it a one-to-one? There's a couple of ways that you could have hedged it with different banks. There's quite a lot of permutations there. So the simplest way to cut through all of that is just to say transition both your loan and swap on the same day to the same interest rate benchmark and use the basis swap rates and do that in the next 6 to 12 months. That would really be the cleanest path through the maze. Hedge accounting is quite a complex topic. It's definitely determined by customers' accounting policy, whether you're under IFRS we're under US GAAP and the specific guidance from the auditors. So when it comes to this, on the specifics of your loan, we definitely suggest that you should speak to your auditors and get independent advice on these from the customer's point of view. Okay, so that's just touching on this point that's and being very transparent that there is complexity when you have both a loan and a swap in your hand and you're trying to move both parts at the same time. Okay, that's on Hedge Loans. Next. Yeah, then let's go to syndicated loans next. So syndicated loans add another level of complexity because it's not just one bank and one customer, but there's multiple banks on a large syndicate. And we are requesting the agent banks. We've already had this discussion within the corporate loan subgroup for the agent banks to play the coordinating role between the lenders and the borrowers. Obviously, it has to be an agreement among the whole panel of banks, but we're asking the agent banks to step up and take the lead role in informing the syndicate lenders and borrowers of SOR discontinuation and the need to transition to SOR. Obviously, setting out the transition options and timelines, we've spoken at length about SORA and how to use the basis swap and so on, and engage advisors such as deal counsel to make the required assessments. So this is not the largest pool around, but it is still significant. And if you think about it, the pool you really have to be focused on is syndicated loans maturing after the end of 2024. That's an area where it's really important to start the discussions early and make the transition as soon as we can, right? But I do stress that the steering committee would have to leave the lenders and the borrowers to make the relevant commercial decisions here. Okay, so that's for the syndicated loans. For SMEs, we've had various feedback, various discussions. We've done a couple of surveys. And at the end of the discussion, the steering committee would recommend that banks should provide the option to transition to compounded in advance SORA loans. So SORA, as you know, is a benchmark that's compounded in arrears. So at the end of the compounding period, you know what the rate is. For SMEs, the banks should actually assess the suitability of SORA for corporate customers, and particularly if payment certainty and advance is a key requirement, compounded in advance SORA should be one of the transition options provided by banks. So we're doing this, for example, in the housing loan space and offering that as an option. So for the SMEs, and particularly smaller SMEs, where the focus may not be interest rate risk so much, but may be more liquidity and cash flow, and you want to know exactly what your payment's going to be at the outset of the interest period, then compounded in advance SORA would be one of the transition options that SME customers could look to. So those are our 5 recommendations as regards the timing, as regards the pricing, as regards Hedge loans, as regards syndicated loans, and as regards SMEs, right? So those are the points, and obviously we can, have more discussions in the panel, but we just wanted to lay this out as the key messages that we don't want to lose sight of. Okay, let's move on. Okay, so I do hope that all the banks in this call are familiar with the fairly voluminous materials that have been provided on the ABS website. I'll just explain which are the materials that perhaps are helpful, and I've contexted them and sectioned them a little bit. So we've already sent out a letter to the corporates in May last year, telling them about this transition. So that's been done. And as Bernard said, there will be a customer engagement letter that's going out in July. So customers obviously will then be approaching banks. So we'll make sure that banks now are briefed. So for the corporates themselves, we've done a fairly simplified guide for SORA. We've done a lot of work on that. And we've also provided an end user checklist together with Pricewaterhouse, who have helped us draw this up together. And we've put some basic FAQs out there. So for the corporates, if you don't want to delve into the details, we need a primer to read what this is all about. These first 3 documents are extremely readable, and we've worked quite hard. The subgroup and the steering committee secretariat have worked quite hard to get these into shape. On the right side, there are more technical documents, which are more for the banks to read. So I would also call attention, for example, to the SORA Market Compendium. So the entire list of loan conditions. We've done quite a bit of work, and again, I saw a couple of questions on that. We can pick up more details, but broadly, the market compendium covers all the products, so derivatives, bonds, loans, retail loans. But in the loan section, you will find that we've actually gone through 17 specific points. There is legal wording in there, and it would be a fairly simple task to take that legal wording and incorporate it into a SORA loan document. It covers a lot of things. For example, holiday calendars, observation periods, and so on and so forth. So there's a lot of work that's been done by the subgroup. Really thank the other 13 banks in the subgroup who worked very hard, and the legal subgroup, subgroup 5, Chicken and Joyce are on the line for the panel discussion, who have been fairly helpful in helping us get to this point. So there's a lot of material out there. So we thought it's helpful on the one hand to say, here are 5 key messages for the customers. But on the other hand, if we want to go deeper and get into technical details, there are documents, and there's been a lot of work that's been done, as what Bernard and Dan had mentioned, over the last 1.5 to 2 years or so. So I will end there, and I guess everyone's relieved we're past the trough, and it only gets better from here. So I'll hand over to Nicolette from UOB, and Nicolette, all yours.
Thank you very much, Philip. Thank you. My name is Nicolette Rappa, and I lead the Communications and Public Education subgroup. And obviously on this panel, I am in very good company here. Philip's gone into so much detail. I think I'll just give a broad perspective as to the approach that we're taking for the customer communications. And it really can be split into 2 parts. The resources that would help you initiate discussions with your corporate customers, and also to encourage their active transition within the next few months. And there's also going to be a public education campaign that's focused more on the retail customers and the small businesses. I'll touch on that last. So as a reminder, up on the screen right now, you see is what's been provided over the past 12 months, starting from bottom left. The communications process really began with a primer letter for your corporate clients to help you inform them of the need to transition their SOR pegged loans and to assess their exposures and contracts that needed to be transitioned. Following that, the SC-STS published a checklist for them to reference and to consider the practicalities as they prepare for the benchmark transition. And then a guide for corporates and SMEs on the background to changes in the Singapore dollar interest rate market, the impact on companies, as well as on how to minimize disruption arising from the transition. So to help the banks, now that's the top half of this slide, the SORA market compendium, which Philip referred to a moment ago, was published to facilitate awareness of the transition, and also the key issues to consider for existing or future Singapore dollar financial products that may be affected by the transition. In January, a set of FAQs on the transition was made available to help you address queries from your corporate clients, covering questions on new and existing loans as well as derivatives. And in March, the SC-STS published the timelines for banks to stop issuing SOR derivatives and SIBOR-linked financial products. Just a couple of weeks ago, a SOR to SORA transition key messages and technical guide was made available to help you encourage your clients to transition their outstanding legacy SOR loans to SORA within the next few months. So as and when required, these documents will be updated to include the latest information and to keep them all current and keep you informed. So then what's next? That's the next slide. So this month, a customer engagement letter will be made ready for you to adapt to send to your clients. It will reiterate the need for the transition, for them to assess the impact on their business and to act early and swiftly. It also highlights that SIBOR-based loans are not going to be available after September this year, and calls out SORA as the alternative. It'll also have a fact sheet with accompanying infographics for easy reference. Next month, the SC-STS will publish a guide on legacy transition. Bernard referred to this earlier on, and so did the other 2 speakers. That will cover the key areas for banks and non-bank financial institutions to consider when managing the transition. From August, to increase awareness and understanding of the SOR transition and to encourage active transition, the ABS will be organizing webinars and masterclasses with various industry bodies, such as the Life Insurance Association, Singapore Business Federation, and such. So you would know, and possibly you would have also participated in the past webinars and masterclasses that have been held over the past few months. Well, this series will continue for industry players, and we invite you to them when they come about. So on to the next slide, please. And this really is about raising broader awareness, primarily for the retail customers, but also to include the small businesses. So we're running a public education campaign, and that is going to be split into 2 phases. The first one is slated to start in late August and should run for about 3 months. It'll set the context for the transition, what home loan borrowers, existing and prospective for both private and HDB properties, need to know, can expect, and what they should be doing about it. The second phase of the campaign will take off in the second half of next year, and it will aim to reinforce and to deepen their understanding of what SORA is and the urgency of the affected customers to make the transition take action. It'll also highlight to the affected customers the channels available to them should they require help in making the transition. So once again, all the resources that I've highlighted here and that Phil's mentioned earlier will be hosted on the ABS website. They're also hyperlinked on these slides, so it's easy for you to retrieve them and reference them after this session. So I thank you, and I now hand over back to the ABS.
Thank you, Nicolette. Now we'll take your questions. Moderating the Q&A session will be Jonathan Phua from DBS, representing the subgroup on business syndicated loans. The panelists will be the earlier presenters, Bernard Wee, AMD, MAS, Daniel Koh, Philip Fernandez, Nicolette Rappa. And joining us on the panel will be Lam Chi Kin and Joyce Lai from DBS. They are chair and representative on the legal subgroup respectively. Yura Mahindru from PwC, representative of the subgroup on accounting and tax, and Elvin Teo from MAS and the SC-STS Secretariat. Jonathan, over to you.
Thank you very much, Lisa. And here on your screen, you can see the link and passcode for the Pigeonhole, which is where we are collecting your questions. We currently have 25 questions on our Pigeonhole, so thank you for those who have submitted questions and assisted in voting to rank the priorities that are important to you. We will go over the questions with the most votes first, taking care to try to avoid duplicating any points of discussion in the panel. So the first question has to do with the credit adjustment spread. What is the recommendation for credit adjustment spread for outstanding SOR loans that need to be transitioned to SORA? So I think this was addressed by Phil's first recommendation, which described how the steering committee intends to recommend the use of the SOR-SORA basis swap rate to calibrate the adjustment spread. Phil, would you have any further things to add?
No, I think that was precisely the first recommendation. So I think we can take it that's been covered in the deck itself. So I'm fine with that.
Okay, great. Thank you, Phil. So we will now move to the next question. What happens after the sweet spot ends? So this is a popular question that has shown up a few times in the questions on the Pigeonhole. So what happens after the 6 to 12 month window that Bernard mentioned, in which you have robust liquidity in SOR-SORA basis swaps markets? So I'll ask Phil to take this question, and then subsequently Dan, if Dan has anything to add.
Yeah, I think the main point we'd make is let's not put ourselves in a position where we need to answer this question. I think that's the most basic thing. I think Bernard said that at the outset. And really, we are starting to get into a guesswork situation as to how the rundown of derivative contracts, because remember that the price discovery is coming from the derivatives market to the loan market, right? So Dan's outlined the burn down of the legacy book and the timelines that would happen. So I don't think any of us could really add a lot, but Dan, if you want to make a couple of comments on what might happen after that.
No, I think that you covered it, right? We don't have a crystal ball, right? So we know, what we do know is that after Q3, the banks would not be transacting new SOR derivatives, right? You can only do trades which are risk mitigating. So in my earlier slide, I showed the outstanding SOR notionals going down. I think that will go down even quicker, and the new SOR originations will go down even more drastically, right? So there's a window that will open up, right? And that's within the next few months. And really, thereafter, if you're waiting, you could find yourself in not an ideal situation. So it's, you know, as mentioned by Bernard and Phil, really just use this window. And furthermore, right, once SOR derivatives goes down to the trading of it goes down to a level in which it is deemed to be illiquid, right? The other problem you face is what I mentioned, right? LCH will then likely force convert whatever you have outstanding. So, you know, the no regrets is really to work hard over the next few months to transition these over.
Great. Thank you very much, Dan and Phil, for your response to that question. So we'll go on to the next question now, which has to do with the recommendation to use the basis swaps MidWeight for the transition of legacy derivative contracts. And the question is, if banks choose to price in a spread above the MidWeight, meaning to deviate from the recommendation, then what might be the issues such as conduct risk? Maybe I will ask Phil to answer this question, and then I will see if the Secretariat, Bernard and Alvin, have anything to add.
Maybe if it's focused more on the conduct risk on the legal side, I don't know whether Chikin or Joyce might actually be better placed to speak to that.
Chikin, Joyce?
Yeah, I think we've got to kind of like be very sensitive to the reasons why that is the case. And I think if there is a solid reason for supporting this, right now I can't really think of one. Or if you're comfortable that there's actually a parity of bargaining power between yourself and the client. So I'm just trying to think of ways to kind of see whether this is acceptable or not. But otherwise, I think, you know, pricing at the midpoint makes the most objective sense. If there's a deviation from there, then typically it might raise a risk issue.
Thanks, Chikin. And I would add that with the recommendation coming out from the committee to use mid-market, if a bank wants to go to do something different, then it is for the bank to explain to the customer why it's doing something different and to reach an agreement with the customer.
Thanks, Chikin and Bernard, for their response. We'll move on to the next question now, which has to do with the calculation methodology for credit adjustment spreads, and specifically there has been feedback from the Singapore local banks. I think, as Phil mentioned, it's important to note that the decision to use a particular methodology for the spreads was taken at the steering committee at the SC-STS level, which includes representation across the industry, including the Singapore local banks. Phil, would you have anything to add to that point?
No, I think it's a collective decision, and all feedback was incorporated in that discussion at the steering committee, and it was taken jointly. So there's no, yeah, it is basically an industry decision. I don't know if Bernard has got any points to add to that.
So no, nothing else to add.
Okay.
Thank you, Phil and Bernard. We will now move to the next question, which has to do with whether the steering committee will publish detailed SORA loan conventions. So the steering committee has already published a market compendium, as Phil mentioned, with fairly detailed loan conventions written in a legal format. Maybe I will ask Chikin and Joyce from the legal subgroup to opine on whether there will be further publication of clauses and terms.
Yeah, we've actually signaled. I'll hand over to Joyce in just a second here. We've already signaled that we expect this market compendium to be a living document and to be updated reasonably frequently. And the next update is currently being worked on. If I just take a step back, the process by which we arrive at this and the usefulness of the market compendium is so that the market doesn't fragment and end up with all kinds of different versions of drafting, each being advised by a different law firm, right? So we're trying to standardize as far as possible by publishing the market compendium so that everybody can use that as a reference. It's also a useful reference to show to your customers to say that, look, this is the basis on why the bank is trying to ask for this particular convention to be used. It's because it's found in the market compendium. Just reading through the questions, there could be the case where we end up with, either very widely acknowledged clauses which are not in the market compendium, or we end up with outlier clauses that people want to insert into the market compendium. I do want to kind of give assurance to the market that we run a fairly detailed process of socializing what goes into the market compendium or not, so that if you are in the situation where we're not recognizing a widely acknowledged clause, then you have every avenue to reach out to SG5 to ask for its inclusion, and we'll work through the process with SG3 and SG4 as appropriate. But I think at the end of the day, if you do end up in an outlier situation where you have a clause and it's not actually widely used, and the process actually has found out that there isn't wide support for that clause, then we will have to say we won't put it into the market compendium for that exact reason, because it's an outlier following the process that we had. Joyce, you want to pick up this? Because I think there are quite a few questions on, are we going to include this type of formatting, this type of compounding, or what else?
Yes, thanks, Chikin. The compendium came up a few months ago. So the SORA loan conventions that we have set out in quite a lot of detail. So the substance is there, and there is some drafting provided around it, but it is not a full-blown LMA style template. So that I think we acknowledge. But the thinking around that is also that your in-house counsel or external counsel will be able to draft around that, given that the substance and the material conventions have been set out in some level of detail. There are reference materials out there like the LMA templates in any case, or the APLMA exposure drafts. So we would hope that putting those pieces together, the market and banks and customers will find enough guidance when they're looking at their negotiations. But in relation to specific clauses that we've seen in the Q&A panel around NCCR, non-cumulative compounding, or talking about the different conventions around look back or observation shift, we do set out that in the compendium. There is some explanatory material and some commentary. So some of that is there. And as Chikin says, we will go through the process of working through and recognizing the developments in the market since the time the compendium came out to now. And we're in the middle of updating it for the first time. So we will take on board what we see as developing trends, if we're seeing that in the market, and we'll make available, some other options, and again, accompany that with some commentary to help the market as well. But for the outlier clauses or something that's quite brand new and we've seen once or twice, we may need to keep a watching brief on that. So it may not come out in the upcoming update, but perhaps if we see that carry through for a little more longer, then for the coming update next on the horizon, you may see that come into the compendium. That was the point of having a living document that we can reflect market trends, given this is a new area, and we would expect some trends to perhaps change or develop as time goes on.
Well, thanks very much, Joyce and Chee Kin, for that comprehensive response on the compendium and how we plan to update it. Moving on to the next question. I'm going to pull up on the screen now. So there is a set of questions. This is not the only one. There's a set of questions that go a bit into greater detail about the mechanics of determining the mid-rate and other aspects of crystallizing the mid-rate for the purposes of calculating a spread adjustment. So this one asks, how do we determine the mid-rate for the SOR-SORA basis? Will there be a fixing page so that the industry can refer to a single page? So for this, let me ask if the Secretariat, maybe Alvin or Bernard, can address the question of the fixing page.
Why don't I start first, and then Alvin, if you have anything to add, feel free to add after that. So when we talk about mid-rate in market, I think we do recommend some principles-based ways of determining it. Number one, that there has to be agreed between the bank and the customer, and second, there should be maybe a short look-back period over just to smooth out the day-to-day volatility and to improve the robustness of the rate using a larger sample of inputs. Now, specifically on the question about whether there'll be a fixing page for the purpose of clarity, we will look into this and we'll think about whether there is a need to recommend possible pricing sources for the mid-rate, for example, from brokers such as Talet or data providers like Bloomberg or Fernandez. So that's something we'll look into. But again, I want to go back to the principles. That is, what's important is for the bank to come into an agreement with the customer on the pricing source and the timing of the transition, as well as the period over which you will do the averaging. Alvin?
Yeah. Hi, Bernard. I think you've addressed most of the points. I think we need to be quite careful in regards to this question. There's a balance point between providing too much specificity and being too general, I guess. I mean, the most general is just use the mid-rate, and in which there could be questions from banks and customers as to, well, which price source should I use? Should I use the noon rate, 11 o'clock rate, and should I average it over 5 days or 14 days or 21 days? And to the extent possible, I think we, within the steering column, will try to find agreement on some of these general approaches. But going too specific into saying that you must use this particular pricing source at this particular hour, I think that becomes challenging for all sorts of reasons. To summarize, essentially, we will look into this further, I think, and by the July publication, there should be sufficient guidance in there to outline exactly what should be the approach and how much flexibility there is. Hope this helps.
Thanks very much, Bernard and Alvin, for that further clarification on the mid-rate. Moving on to the next question. So this question has to do with the non-cumulative compounded rate methodology, which is a way of calculating interest. It is a legal convention. And so I think this is already largely addressed by what Chee Kin and Joyce mentioned on the updating of the compendium to take into account different market conventions as they arise. Maybe Joyce, do you have anything to add to this point?
No, other than to say, look out for this. NCCR is something we plan to include as an option for consideration. I think right now in the compendium, we do set out pros and cons as well to help parties consider different options. But in relation to something relatively new, like NCCR versus the original CCR, until there is a definitive trend, I think we may still want to leave the options open for consideration, and then just point out things to take into account for parties considering them, as opposed to straight off coming down in favor of use NCCR in every case. So it's about weighing different considerations for the different options around. But this particular one, we expect we will pick it up, and hopefully the guidance we provide there will be helpful.
So maybe I can just chip in a little bit on that question. So the value of the NCCR approach is if you need to break a loan in the middle of a interest period. So the computation is easier at that point, but it loads the complexity onto the daily calculation. So this is to give more flesh to Joyce's point about the pros and the cons, right? So different banks have built their systems in different ways. So most likely, and we'll give more guidance at the next update of the compendium, most likely we will recognize both approaches. But as what Joyce said, it's not really the place of the steering committee to opine on which set of pros outweighs which set of cons, where it's clearly quite a judgmental call. And this is, again, in the spirit of what Alvin just said about providing options, but not being so specific that, yes, we will all use the non-cumulative compounded rate methodology. There are pros and cons of both approaches. So just to be quite transparent on this specific point.
Thanks, Joyce and Phil, for that response. We'll move on to the next question now. So the next question has to do with new SORA loans. So there's a second part to this question. What happens after the 6 to 12 months, which I think has been answered. So the first part, essentially the question is how to price the spread for new SORA loans, and if the SC-STS is going to make any recommendations as such on that point. Phil, would you like to take this question?
Yeah, for new SORA loans, it's very straightforward. You just price it as SORA plus the spread. So each bank would have its own funds transfer price, which reflects its cost of funds. And the loan department would price it to take a customer margin above the cost of funds. So everything we've spoken about in this presentation is about legacy transition. So none of it applies to new SORA loans, which is purely driven by market supply and demand and negotiation between the bank and the customers. I don't know if anyone else wants to chip in on that, but that's how we see the issue.
Thanks, Phil. We'll move on to the next question now, which pertains to derivatives. So the next question is, do banks still need to complete transition for legacy SOR derivatives, which mature before mid-2023, in order to meet certain milestones that the SC-STS has set? So maybe I'll ask Dan to take this question.
Actually, Alvin, I think you're better placed for this.
Sure then. So the SC-STS wind down timelines apply to the entire stock, regardless of the maturity date. I mean, which is why we also don't say wind down to zero, right? There's a little bit of buffer here and there to take into consideration various aspects, including one, maturity date considerations, two, your derivatives with other FIs that have some form of linkage to your corporate derivatives, which will take a little bit more time to wind down. So these are the various considerations driving these buffers that we have incorporated within the targets set out by the SC-STS for the quarters in 2021. Hope this helps.
Thanks, Alvin, for that clarification. We are moving on to the next item. So the next question is a more technical question that has to do with a convention for flooring the interest rate computation for SORA loans? Specifically, does the committee recommend the zero rate floor to be applied on a daily basis before compounding? So I'll ask Phil to take this question, and then Joyce, if there's anything further to add from a conventions and a legal perspective.
SORA itself has not gone negative for a long period of time. Joyce, can you recollect if we handled this point specifically in the market condition? I think we did say we would floor it on a daily basis before compounding, but can you confirm that point?
I think we did touch on that point in the compendium, but it is something we plan to clarify in the coming update of the compendium that we mentioned we are working on, because we have had feedback from some members of the market about zero rate floors and how to handle that. And there is discussion around you floor the rate on a daily basis, or do you floor the rate plus your margin or spread, for example? So we will go into a little more discussion on that in the upcoming update in the compendium, but there is some commentary now already and a position set out in the previous original incarnation of the market compendium.
Thanks, Joyce and Phil, for clarifying that point on this the flaws related to the compounding. Moving on to the next question, which I think is pertaining to derivatives. So the recommendation to transition at the SORA basis midweight, is that applicable for loans only or derivatives as well? So as Phil mentioned in his recommendations, there is a recommendation issued for derivatives that are hedging loans. And of course, Phil's recommendation pertains to the transition of loans. So I think this question is more about for derivatives that are not hedges for customer loans. Does this recommendation apply? Maybe I'll ask Dan to answer that question.
Yeah, sure. Thanks. So for derivatives, we as I mentioned, right, we're looking at it from a few perspectives, right? So we're asking the banks to compress the outstanding SOR trades, right? So insofar as you have the ability to backload these into the clearinghouse and then work on compressing them, that would be basically your first option, right? And then we are also looking at conversion cycles where we are looking at converting SOR to SORA trades through the clearing through the vendors like TriOptima as an example, right? For bilateral loans, swaps that you cannot convert, cannot backload. Yes, right. We would encourage you to use whatever is in the market, and there are market rates for these, right? So you can go into you can do SORA basis swaps in the market where, you know, as I mentioned, the bid offer spreads are actually very manageable, right? The 1 to 2 basis points really what we have right now for the shorter tenor ones. It's something for you to work out with your counterparty, right? You should obviously try to, as I think Alvin and Bernard mentioned earlier, try to go into mid-rate as much as you can for you to work this out with your counterparty.
Thanks very much, Dan, for that clarification on the rate used for transition of derivatives. Moving on to the next question. So this question relates actually to LIBOR, which is not something that we have formally covered in today's presentation. So maybe I'll pose this question to Bernard and Alvin from Secretariat, whether there is a plan that there will be formal milestones published by SC-STS for LIBOR contracts.
Thanks very much, John. This LIBOR will not be dealt with by the steering com because steering com is only responsible for SOR and SORA and SIBOR. So for LIBOR, MES through supervisory channels issued a circular on our supervisory expectations on how banks should manage their LIBOR exposures. For new exposures, referencing LIBOR, dollar LIBOR, we should not enter into new contracts for dollar LIBOR by the end of December 2021, and for non-dollar LIBOR by June, which is this month. For outstanding contracts, we also prescribed timelines to transition outstanding LIBOR contracts either to fallback rates or to risk-free rates. So for instance, for non-dollar LIBOR, the timelines was September 2021. So I would encourage everyone to refer to the circular that was sent by MES in April.
Thank you, Bernard, for that answer. Moving on to the next question. There is a set of questions that pertain to further specifics around what will be recommended with regard to the usage of the MidWeight for pricing the spread adjustment. So this is the first of these questions. So this question pertains to tenor basis. So the SOR basis is based on 6-month tenor, and however, there are loans that are priced off of 3-month and 1-month tenors. So how would we address this difference? There is a difference in these SOR tenors. I think there's also another question on this point. Is the SC-STS going to issue any recommendations with regard to pricing the adjustment spread for tenor basis? So between, for example, 3-month and 6-month tenors. Maybe I'll steer this to the Secretariat. So I'll see if Bernard or Alvin, you would want to comment on this.
Thanks, John. This is actually a fairly technical question. I think it is a good question and something that the CIRCO will have to provide a little bit more clarity on. My sense on this, without taking a look at the numbers in front of my screen right now, is that when you talk about a 5-year on a 6-month SOR versus a 5-year on a 3-month SOR, the spread differences start to narrow out versus a 3-month SOR at spot versus 6-month SOR at spot. But it is a good point, and we will take it back into the discussions for further elaboration in the guidance that we published in July.
Thanks for clarifying that, Alvin. So we'll look at the guidance, the detailed guidance to be published in July, and address this point there. Moving on to the next question. So this question has to do with forward-looking term rates. So I think the question is asking what is the market acceptance of backward-looking rates by corporates, and suggesting that there may be a role for forward-looking term rates which are used in the US market, such as MRIBOR, BSBY, etc. I think the question is implying a query about term SORA. So maybe I'll direct this question to Dan, and then subsequently, if Alvin from Secretariat has anything to add about term SORA.
Yeah, thanks. Well, what we have seen, right? We have had quite a few transactions with our corporates for SORA already, right? So in terms of the first question with regards to market acceptance, we think it's doable. We have done deals with corporates already, and I think as the market gets more used to it, I think you will see the acceptance of this continuing to increase, right? And that's something that will evolve over time, right? Yes, the US is exploring other such reference rates, and so forth. They also were looking at possibly a term SOFR, right? Which is something that we are exploring. But until and unless we have a much more active, robust swap market out there in SORA, it's really too early for us to put any credence on that happening in the near future, right? It's something that we are obviously working on, but right now it's not something that we can create without the market becoming a lot more liquid.
Thanks very much, Dan.
So I think there are a couple of dimensions to this particular question, right? Which is not perhaps made explicit in the question itself. There's the forward-looking term component, there's a credit dimension, and then there's this issue about customers wanting advance notice. I think in the earlier customer segmentation report, which the STEERCO had published, it is made quite clear that where customers require advance notice of future interest payments to be known, actually the compounded and advanced SORA does provide one option for this to be achieved. Right? This doesn't have that forward-looking term component, but it does allow you to provide notice to the customer of what's the next interest payment that they need to make in 1 month's time or 3 months' time, etc. So that's the first component. On the credit component, I would say that in the US dollar space, this continues to evolve. There are few varieties of possible interest rates that the markets are considering, and the market hasn't quite landed there. In the UK space, in contrast, I think SONIA continues to remain the dominant rate that markets are looking at, and term SONIA in particular is something that the market is looking into for providing that forward-looking term reference. As Dan highlighted, term SORA is also something that we will look at, but this is caveated by the fact that it requires a very deep derivatives market, which no one at this point can guarantee you. So these are the various dimensions to this issue.
Thanks very much, Alvin and Dan, for your answers. Move on to the next question, which has to do with the credit adjustment spreads and the US. Essentially, this question is saying SOFR has fixed credit adjustment spreads that were fixed when the FCA announced LIBOR discontinuation in early March, based on the 5-year historical median. And why are we not pursuing that same approach for SORA? So maybe I'll direct this question to Alvin from Secretariat, who can provide further context behind the deliberations.
Thanks, John. I'll mention a few points, and maybe I don't know whether the rest of the committee here wants to provide some views as well. I think on this we hark back to early discussions in the STEERCO in late 2019, where there was a discussion on the back of ISDA consultations on what actually would be the best fallback rate for SOR contracts, right? And then at that point, we had considered 2 possible options. One is fallback rate SOR, which we all know now how it's constructed, essentially FX implied from the US dollar fallback rates, right? And the other was something much more like the fallback rate SONIA and fallback rate SOFRs, where it would be a fixed historical spread against a compounded SORA. And the analysis on the numbers there, and each of the banks here can do their own analysis on it, showed that the spread between SOR and SORA is somewhat cyclical, right? It varies over time, and therefore the establishment of a fixed period for the determination of that spread, which is very arbitrary, by the way, will have great influence on what that spread number is. So whether you use a 1-year period, 3-year period, or 5-year period, this has impact on what that number is, and much more impact and much more arbitrariness than in the case of other currencies where the spread between the rates are less cyclical and volatile. I mean, this owes in part to the fact that ours is FX implied rate versus a clean, and the other to the fact that in the Sing dollar space, we do not have an interest rate policy, and therefore rates tend to move up and down a little bit more. And hence fixing that rate on a historical spread introduces some complications, and hence that was not chosen as the fallback rate for SOR on the basis that a fallback rate should as one key consideration be somewhat similar to the rate that you replace. So with that, the approaches to the fallback being different, it also then affects how you think about transitioning of legacy contracts, because the US dollar approach, which is referred to in this particular question, harks a lot to the fallback approach on fallback rate SOFR for dollar LIBOR contracts. I hope that provides some kind of color to the thinking on this issue.
Thanks very much, Alvin, for clarifying the kind of historical, the previous thinking and deliberations on the committee with regard to the setting of the credit adjustment spread. Move on now to the next question. So I think we have 16 questions currently in the pigeonhole. And this next question has to do with the recommendations with regard to SME SOR loans that are outstanding. And the question has to do with the approach to be recommended for the spread adjustment to transition outstanding SME SOR loans to SORA using the compounded in advance SORA. And the question asks, is the SC-STS thinking of making any formal recommendations for this segment? So maybe I can steer this question to Alvin to see, has there been any deliberation on a specific recommendation for SME SOR loans?
Thanks, Sean. So I think the committee did discuss a couple of things. One is that it certainly has landed on an approach for the retail space, the transition of retail loans. This is not the focus of today's discussion, but certainly this guidance will be provided in the July publication and subsequent outreach, right? And so the big question comes to this gray area of the small SMEs, right? And on this particular point, and Phil can add on after I say if I miss out anything, our sense is that banks have different ways of classifying their customers, and it's best not to draw a specific hard line to say that if your customer is this number based on annual revenue, that you are automatically a small SME and you go through the retail approach, right? There's a bit of grayness there, and therefore the recommendation will provide this flexibility for banks with their customers to transition those very small SMEs who do need the advance notice on interest payments via the retail approach. And there would be some need for flexibility on the bank's part because some customers could be facing more than one bank and therefore would appreciate a certain consistency between the banks that he faces. And that's kind of where I think the discussions are at this point. Don't know whether Phil, you want to add on to those points?
Yeah, agree with everything Alvin has said. That's where we are in discussions. So for the small SMEs, the likelihood is that they would prefer compound in advanced SORA, and they can go under the retail route, which is under SG4. So SMEs, unfortunately, is quite a broad tent, right? Whereas for the larger SMEs, which are not, who actually may have even got swaps with banks, they're much better off working with the in arrears SORA so that they can actually match that off with their swap. So it's hard to come up with a one-size-fits-all for SMEs. So as what Elvin said, if they're on the smaller end of the spectrum, we're okay that they go through the SG4 route. And if they're on the larger end of the spectrum, and they may even have swaps with banks, then they're better off following the corporate route, which is everything we've spoken about today. Okay.
Thanks very much, Phil and Elvin, for addressing that question. We'll move on to the next question, which has to do with trade loans. The question comments there isn't very much market adoption for trade loans, unlike non-trade loans and derivatives. So what are the recommendations of the SC-STS with regard to trade loans? On this point, I would highlight that one of the documents that Phil mentioned, the overview for the usage of SORA in loans, does make comments on the appropriate use of SORA for loans such as trade, retail, and SME loans. Phil, would you have anything further to add to that point?
Yeah, so if you look at the trade loan book, most of the trade loans are actually bullet structures. So what happens is there's an overall facility letter, and then there are short-term draws on that. So the facility letter may reference a benchmark, and we think the benchmark should be SORA. On the other hand, if you look at how individual draws are done, it would be done at 1.35%. All right. So you could calculate the difference in 1.35% and SORA and see that's a spread, but it's just being repriced every time there is a draw, and you can't. It's different from a long-term floating rate SORA peg loan. So I think that's the big difference between the trade book and the corporate loan book. There is a small set of trade loans where it's like a 1-year trade loan with 3-month repricing, and for those we would recommend that you go to SORA. Right. So largely a bullet book. Facility letters should be pegged to SORA, and for that small subset that are floaters, then do it against SORA. That would be our recommendation.
Thanks very much, Phil, for that clarification on trade loans. Moving to the next question. Finally, a question on tax. I think I'll steer this toward Yura, who represents the accounting and tax subgroup. Yura, will IRAS, where are we with regard to, engaging IRAS on guidance on tax treatment with regard to the SOR transition?
Yeah, thanks, Jonathan. So similar to a number of jurisdictions, we see tax authorities studying IBOR transition, and we've had a fair bit of dialogue with IRAS and some questions and back and forth. So they're working through it. We've seen some early jurisdiction guidance come out in other territories. So in the UK, as an example. So essentially, they're looking at it, they're working through it. We don't have a timing at this stage as to when that guidance will come out, but we're working with them to move that along.
Thanks very much, Yura, for clarifying the timeline for guidance on tax treatment with regard to SORA transition. At this point, let me check with Nicholas from ABS. Do we have additional time to address the questions?
Hi, John. Actually, yes, we do. We still do.
Okay, great.
Yeah, I think we have time for all the questions, in fact. We have about 20 minutes left.
Okay, great. So we'll go on to the next question, which pertains to. We'll go to the next question, which pertains to the published rates that MAS currently publishes on the interest rate section of the MAS website. So these are the 1 month, 3 month, and 6 month compounded SORA rates. And the question is whether the steering committee thinks that the market will move toward using these published rates, or whether the market will continue using daily compounding of SORA, which is currently how these loans are calculated. So maybe I'll steer this question to Phil.
We give flexibility to banks to use whichever is more usable. Bear in mind that there are a variety of parameter settings that you can use even for compounded in arrears, right? There's observation shift, there's look back. We talked about the NCCR versus the CCR. So a lot depends on what the customer's specific need is. And also, recollect that the settlement periods for loans are 5 days and for swaps are 2 days. So we would leave it open. I mean, MAS obviously has taken the positive step to put out the SORA compounded in arrears fixings, but that's with specific parameter settings. If a client needs a different set of parameter settings, then it's for the bank to see whether they can support the calculation of that and agree with the customer something that actually meets the customer's needs. So as to which way the market's going to go, hard to say. I think it would be very customer specific in each instance. But obviously, the fact that there is a standard set out there would definitely be at least a reference point, and then you can say, okay, that's the basis, and the market at least has a transparent basis to look at. I don't have anything else to add on that. I don't know if Elvin or anyone else wants to add to that.
Further from me, I think MAS has provided the compounded rates. There's an option for market participants to use if they feel it suits their purposes.
Okay, thanks very much, Elvin and Phil. We'll move on to another question on regulatory reporting. So I think this question is for MAS. Are there any plans to publish guidelines on trade reporting from the perspective of regulatory reporting requirements, in particular for for legacy trades migration from SOR to fallback SOR SORA?
Sure, I'll take this, and I think that there are also a couple more questions on regulatory reporting, which I think I can take together. So we can publish FAQs, may not amount to guidelines. As you know, MAS has a specific type of instrument that we use called guidelines. So I think it's more like an FAQ. There were also other questions on whether we will have to continue. We'll start reporting SORA exposures from the start, and I think there are two parts to it. For derivatives, we already expect banks to report derivative exposures. It does not change under SORA. We'll continue. That's important for regulators to understand what sort of risks banks are carrying on their balance sheet. We understand that this is also the approach in Australia and Europe, so that's no change. For cash exposures, we have been conducting surveys but that's more to, and these are ad hoc surveys, and that's more to understand the progress of transition for cash products, and that will continue as an ad hoc survey.
Thanks very much, Bernard, for clarifying the guidance on regulatory reporting related to IBOR transition and SOR to SORA transition. So we'll move on to the next question. The next question kind of has to do with if there is a limited number. So essentially, I think this question may be on the minds of many of the banks on this call who have a more limited number of SOR contracts, and in particular contracts that mature within 2023. And the question is if these contracts have to be transitioned to SORA. So as Phil mentioned, Phil laid out a few options for transitioning contracts, and in particular, the option of allowing contracts to mature if they mature before SOR discontinues in mid-2023. For contracts maturing after mid-2023, the 5 recommendations under the loan subgroup address how you might think about transitioning these contracts. Phil, would you have anything to add to these?
I think you've answered it quite well, John. So the contract that's maturing before mid-2023, the bank can let that mature. The one before end of 2023, we've got the 5 recommendations. The other point I'd make is that the one that's maturing before the end of 2023, if you don't want to transit it to SORA, the bank does have to insert the fallback language so that it will move to fallback SOR for that particular short period. So this is a very carved out situation, but it doesn't detract from our broad guidance, which is to transition as many loans to SORA as possible.
Thanks very much, Phil. So that addresses the question on if there are a limited number of SOR contracts that mature before 2023. Moving on to the next question. This one I think that we haven't discussed yet has to do with fallback SOR and the point of why we can't, the banks can't rely on just moving contracts to fallback SOR. In particular, the point that fallback SOR is unlike other IBORs. So what has been discussed today is that fallback SOR will discontinue a publication end 2024, which is a decision that the steering committee has made. And this question is asking if to elaborate on other differences that fallback SOR may have versus regular IBOR rates. So maybe I'll steer this question to Dan with regard to fallback SOR and how it is different from SOR and other IBORs that we are familiar with.
Yeah. I'm just trying to understand this a little bit more. I think Alvin did talk through it already, with regards to when he said that why we have a separation of fallback SOR and SORA, and they're completely different benchmark rates, right? Why can't we rely on it? So I completely I'm a little bit confused as to the essence of this question relative to what Alvin already answered earlier.
Dan, if I could step in maybe and see if I can throw some light. I think what the questioner is asking is, if fallback SOR works, why don't we keep it for the long term, right? I think that's where they're going with the question.
Right.
Yeah,
right.
But I think the point is that we're trying to build a market where we've got an opportunity to unify around a single benchmark for both the loan and the derivative group. If we leave fallback SOR out there, then we're never going to grow the SORA swap market, right? I think that was the discussion very early on in the SC-STS. I don't know if that throws some light.
Correct. And yeah, the fallback SOR is really just a safety net, right? I think Bernard alluded to that, right? It's not something that we want to be dependent upon. It is using a rate that is based on a dollar, which is something that we want to move away from as well, right? So we want to be moving more to a Sing dollar self-determined rate that is not so subject to another currency, and one that really there has been some guidance that it should not be used for derivatives unless in a fallback.
Right, thank you, Dan and Phil, for clarifying and addressing the question on why we don't just transition everything to fallback SOR. The final question that we'll answer for today is a more general one, which has to do with downsides of using SORA. If the steering committee has considered any downsides of using the SORA rate for loans and how financial institutions could avoid them. Actually, the question is broader, so I guess also cover loans and derivatives. So maybe I will steer this question to the Secretariat. So Alvin, if you could highlight maybe some of these considerations that have taken place in choosing the SORA benchmark.
Thanks, Sean. It's actually a very multifaceted question, right? But the short answer to this is that SORA is great, right? I mean, essentially, that's the key message that has been going out from the steering committee, and not just in Singapore, across all the major jurisdictions. Move your contracts from your IBOR to the risk-free rate. And this is the central theme of the exercise that has been going on for a couple of years. Why is it great? I mean, SORA is underpinned by much more transactions than your SIBOR or even your SOR, and likewise for the risk rates in the other currencies, right? And yes, there will be system changes, market convention changes that will need to be undertaken, but in the long haul, this has ultimately got to be a good outcome for the market. And you can read a couple of the SC-STS publications in regards to this. One in particular I would reference is the paper on the landscape where we announced the discontinuation of SIBOR and move to a SORA-centered interest rate landscape. And there we had highlighted various benefits, including to improve efficiency in the market, concentrate and improve liquidity in the market, and improve pricing transparency for customers as well. So I think that kind of sums up the work of the steerco, and hopefully that helps to answer this question as well.
Thanks very much, Alvin, for clarifying the steerco's view on the benefits of using SORA. And with that, I think that's a really good way to wrap up this Q&A. There are a few more questions which are more specific, and I will suggest for those who have submitted these questions, they are a bit more technical in nature. If you could send them to the SOR Transition email address, which will be shared shortly, then these questions can be taken up and responded appropriately in the subgroups.
Yes,
thanks very much.
you.
Handing back to ABS.
Thank you, Jonathan. Thank you, Jonathan, for your moderating this Q&A panel session. Thank you very much. And ladies and gentlemen, we've come to the end of this afternoon session, and we hope you had a useful and a fruitful time. And as Jonathan has mentioned, any additional questions sent to sortransition@abs.org.sg. Now, today's session has been recorded, and what we will do is post it up on the ABS website, and it should be up by next week. So now and also before I go off, may I just please, gentle reminder, please complete the feedback on the pigeonhole to give us your feedback on today's session. Thank you very much. And now it leaves me to thank Bernard, Wee, Daniel, Cole, Philip, Nicolette, Chikin, Joyce, Yura, Alvin, last not least, of course, our very efficient panelist moderator. Thank you very much for your time for this afternoon with us. So have a good afternoon, ladies and gentlemen. See you again. God bless. Bye. Thank you. Thank you all.
Thank you.